So, how much are you? You are probably thinking, what kind of question is that? Now, before you get all offended, no one is trying to sum you up in a sum of money. That is preposterous, right? You are much more than that. You are a human being with feelings and dreams. You are special. You can't be regarded as something to put a figure on. Your value is intrinsic to your very existence. We humans are the most amazing and valuable creatures there are. That's neat and dandy, but how come we put a value on everything else? How come everything costs money, but we are absolved? Well, not really. What is the first thing we ask about when we take interest in a famous person? What is their net worth? Isn't that summarizing them in a figure? Isn't that how we measure success? Forget about that. When somebody hires you, aren't they buying your time and effort? Let's leave effort aside. Isn't time the most valuable asset you have? Isn't it your life? They are buying 8 hours of your day, 1/3 of your day, hence your life, for a price. You belong to that boss for 8 hours. Do as you're told. Don't make mistakes, and work your behind off to keep that job. Then, go home to sleep and do it all over again tomorrow. You sell your best years, your youth, to wake up old and all wrinkly to find out that they put a figure on your retirement benefits. Players are traded, bought and sold. Life insurance puts a figure on your life if something, God forbid, happens to you. Treatment is not possible without coverage or proper fees. Even governments put a value on your life in case of accident or termination from a job or benefits or whatever. Governments do not typically assess a person's worth or value in a moral or ethical sense. However, governments do use various methods to assess an individual's financial worth. It is not a reflection of their inherent value or worth as a human being. Now, everyone keeps assessing you and putting a price tag on you, but you won't. You refuse to admit that there is an amount that hovers over your head wherever you go. Now, some people go their whole lives without knowing their worth. Others refuse to acknowledge they even have it. Both these types of people could sell themselves short without meaning to. Bottom line is there always is a figure. So, how much are you? If you keep watching till the end, we might help you find out that figure. And hey, you get to meet John. Who is John, you ask? Watch and find out. Calculating a person's net worth involves adding up their assets and subtracting their liabilities. Assets are things of value that you own, and liabilities are things that cost you money and cause the decrease of your net worth. Assets can include cash, investments, real estate, and personal property, like cars and jewelry. Liabilities can include mortgages, credit card debt, and other loans. Here is an example of how to calculate a person's net worth. Let's say John has the following assets. Cash, $10,000. Investments, $50,000. Real estate, $300,000. Personal property, $20,000. John also has the following liabilities. Mortgage, $200,000. Car loan, $10,000. Credit card debt, $5,000. To calculate John's net worth, we add up his assets and subtract his liabilities. Assets, $10,000 plus $50,000 plus $300,000 plus $20,000 equals to $380,000. Liabilities, $200,000 plus $10,000 plus $5,000 equals to $215,000. Net worth, $380,000 minus $215,000, which equals $165,000. So, John's net worth is $165,000. John is not a celebrity. Calculating a celebrity's net worth can be a bit more complicated than calculating the net worth of an average person, as celebrities often have diverse sources of income and assets that can fluctuate significantly over time. Plus, celebrities' earning potential and future projections are taken into account. To increase his net worth, John has to increase his income. He can do this by asking for a raise, taking on extra work or a side hustle, or seeking higher paying job opportunities. He also needs to reduce his expenses, pay off his debt, save and invest. Poor John. Now let's imagine that John is an employee. He is worth something to his boss, right? Otherwise, he wouldn't be hired. His boss needs to assess his overall contribution to the company and his value to the organization. This includes performance reviews, considering skills, assessing potential, comparing his compensation to market rates, and looking at his impact on the organization. That's of course rare to be considered in most companies. The only metric to consider in most cases is profitability. In other words, John can't cost more than he earns. Let's imagine that John is a software engineer at a tech company. He has been with the company for 5 years and has consistently received positive performance reviews. None of that matters. Here's how John's worth could be evaluated. He earns a base salary of $50,000 per year, plus $10,000 in commissions. The total cost of employing him, including taxes, benefits, and training expenses, is $75,000 per year. To be considered profitable, the value that an employee generates for the company must exceed their cost of employment. So unless John is bringing in more than $75,000 per year, he is of no value to the company and his services won't be needed. Poor John. According to a study by PayScale, the average profit per employee for companies in the United States is approximately $15,000 per year. And we all know that this is a modest estimation. Most bosses consider that to be a small amount compared to the headache of having an employee. So to be of value, John needs to bring in at least $90,000, or else bye-bye. Poor John. Now, John has worked for his company till his retirement. Let's keep in mind that his company is a good company that offers retirement benefits to its employees, like 401k plans, traditional pension plans, simplified employee pension (SAP) plans, or simple IRA plans. Time for John to cash out and enjoy his remaining days in peace, or between doctors. Poor John. How much will he get for his faithful service? He gave his whole life to that job, and now it's time to collect. The amount of retirement benefits that a company provides to an employee with an annual base salary of $50,000 will depend on the retirement plan offered by the company. Here are some approximate examples. 401k plan. Assuming an employer match of 50% of the employee's contributions up to 6% of their salary, the employee could potentially receive up to $3,000 per year in employer contributions. This assumes the employee contributes at least 6% of their salary, or $3,000 per year. Traditional pension plan. Assuming a simplified benefit formula of 1% of the employee's average final salary for each year of service, the employee could potentially receive the following amount of retirement income per year after 10, 20, and 30 years of service. After 10 years, $5,000 per year. After 20 years, $10,000 per year. After 30 years, $15,000 per year. Simplified Employee Pension Plan, SEP. Assuming an employer contribution rate of 10% of the employee's salary, the employer could potentially contribute up to $5,000 per year to the employee's SEP account. Simple IRA plan. Assuming an employer match of 3% of the employee's salary, the employer could potentially match up to $1,500 per year to the employee's simple IRA account. This assumes the employee contributes at least 3% of their salary, or $1,500 per year. That's a lot of math with a lot of numbers that amounts to small amounts. Wow, that rhymed. It's important to note that retirement benefits can vary widely based on the specific retirement plan and employer contribution rules. Note that these amounts are for illustrative purposes only and are not exact numbers. Bottom line is, poor John. For governments, one common method for assessing an individual's financial worth is through the use of tax returns. Tax returns require individuals to report their income, assets, and deductions, which can provide a snapshot of their overall financial situation. Governments may also use other financial data, such as credit reports, to assess an individual's financial worth. Credit reports can provide information on an individual's credit history, outstanding debts, and financial obligations that need to be met, or else you will lose your freedom, aka lose yourself. We will conclude with a quote from Maya Angelou, a popular poet and civil rights activist, that says, "Freedom is never free." Knowing your worth and increasing your net worth are the only ways to gain your freedom. Freedom of time, freedom of choice, financial freedom, life. The harsh truth is, you can't own your life unless you buy it. Work on yourself. Improve your finances. Know your worth. And never, never sell yourself short. Don't be like John. Poor John. So, how much are you? Leave a comment below to tell us. If you can't figure it out, comment "Poor John" and we will wish you luck. Live rich and prosper. See you on the next video.